Hi, everybody. Welcome to our the case by case for Bharosa Club Top 150 Small Case. We're absolutely delighted you could join us today. And first off, want to thank Small Case for doing this series. We're big fans of all the things that Small Case are doing. And for any of you that aren't familiar with the platform, highly encourage you to check it out. And in these times of uncertainty, getting together and having these kind of webinars is the best way to collectively prepare and deal with this uncertainty. So thanks a lot to the Small Case team, and hopefully we have a very good presentation lined up for you guys today. So the goal of the presentation is going to be to give you an overview of the strategies we use to manage our small case, and also hopefully to give you some thoughts and strategies that you can perhaps incorporate in managing your own portfolios. So with that intro, I'm just going to pop up the presentation and then we can get started. And then the presentation will be roughly around 30 to 35 minutes, after which we'll open it up for Q&A. Okay, great. Hopefully everyone can see the presentation. If not, just put it on chat and the Small Case team will notify me. Great. So what we're going to be discussing today is top-down and bottom-up investing, and how Bharosa Club uses these approaches to manage its small case. So the presentation will begin shortly, but I'm just going to give you a little bit of an intro to Bharosa Club. So my background is essentially in financial services my whole career, the bulk of which was on the investing side. So I had the good fortune of working for some of the leading institutional investors in the world, in private equity, and then also in the public markets in the United States. And then I came back to India and I helped co-found NBFC. And now I've taken on the reins of Bharosa Club. So Bharosa Club has a very, very simple mission. We want to simplify finance because our view is that personal finance, as the name implies, should be personal. A cookie cutter approach just won't deliver the best outcomes for everybody. You really have to take ownership in your own financial health. And so we aim to help our members make better financial decisions by taking more ownership in their financial wellness. So that means understanding the tools available through learning content, webinars, research papers, comparison tools, and some general Q&A that we also do for our members on many personal finance topics beyond investing. So if anyone's interested in learning more, you can find us at our website and see if it makes sense for you. But the topic today is going to be our small case. So we manage the Bharosa Club Top 150 Small Case. And the approach we use is very similar to our mission. We're keeping this very low cost. We want this to be a service for many people. And we have a low minimum ticket size as well. And really what we focus on doing is being very transparent about our thinking. So every month we issue a blog that spells out what were the changes in the portfolio, and if there were changes, why we made those changes, what we're thinking, so that the investor can decide, do I agree with this thinking or do I not agree with this thinking? One of the big issues we see in active fund management is the investor has no clue about what the fund manager is doing. And we're trying to prevent that from happening in our fund. We really want you to be a part of the process to make sure that you agree with the direction we're taking the fund in. And if you don't, then obviously you can change the fund, right? And invest in another fund. So that's kind of the setup of Bharosa Club. So now let's get into our strategy. So we have a very clear focus with the small case. So we aim to play in the large cap space. Now, typically in the large cap space, the returns are lower and so is risk and volatility. So there's one very clear reason as to why that's the case. If you think about the large cap stocks in India, the Reliances of the world, the HDFC banks of the world, these are very large companies that are very closely followed. There's a lot of news coverage about them. There are a lot of equity analysts following the stock. They're in the media every day. So the oversight of these companies is very, very high. That's why the chances of a huge blow up in these tend to be lower because they're very well covered and there's a lot of eyes on them. And therefore the risk and volatility tends to be lower. But for the same reason, it's much harder to find bargains in the large cap space because people understand these companies very well. So when you're operating in the small cap and mid cap space, you may find a company that isn't very well known, but you've seen all the good things they're doing, and it's a secret. And so you can buy that stock of the company and do very well that way. Those kind of opportunities are not there to that degree in the large cap space. So at Bharosa Club, we have a little bit of a strange mission. We want to play in the large cap space because we like the benefit of risk and volatility, the lower risk and volatility that you get from large caps, but we're still aiming to deliver mid and small cap returns by beating the markets. And I'm going to discuss in this presentation our strategy for trying to do that. So the presentation today is going to follow the following flow. So first we'll begin with a brief introduction to fundamental research. This is really the bread and butter of what we do. We do use a few quantitative screens to help us manage the fund, but the heart of our small case is around fundamental research and decision making. So I'm going to cover with you what that means. Then we're going to cover our approach to fundamental investing. And I'm going to show you then an actual real life example of how we applied this framework to make a decision in our portfolio. And then I'm going to end the talk with a key takeaways for you. What should you take away from all this to help you manage your portfolio better? And then we'll open it up for the Q&A. So let's start with the real high level of what fundamental research even means and why there's an opportunity to use fundamental research to make alpha in the markets. So if for anyone that's not familiar, alpha basically means beating the market on a risk-adjusted basis. So essentially, the first premise that all investment strategies are built on is that markets make mistakes. And because if they never made mistakes, you could never beat the market on a risk-adjusted basis. So you have to be a believer that the market is not always priced correctly and you can find bargains. If you don't believe that, then passive investment strategies make a lot more sense for you. And there's plenty of evidence that markets make mistakes. So if we look even as far back as the 1600s in Amsterdam with the tulip mania and bust, that was a clear example of a market going haywire. Or you look at the roaring 20s, right before the Great Depression, or the Japanese stock boom and bust, or the dot-com boom and bust, or the housing boom and bust in the US. All of these are examples of how the markets can malfunction. Now, why is that the case? Why do markets malfunction? In our view, there are three reasons why the markets tend to go haywire from time to time. One is herd mentality. What does this mean? It basically means that we like other people agreeing with us. When we're investing in something, we feel safe when other people tell us, yes, yes, that's a very good stock, or I think so too. So we like to be in the herd, but the herd can sometimes be wrong. And if you're in the herd, then you may make mistakes along with the herd. Second is fear and greed. We tend to be very fearful when markets crash and very greedy when markets go up. So these emotions cloud our decision-making process. And the third is we suffer from lots of psychological biases, such as confirmation bias, information bias, recency bias. You can read more about these at your leisure, but these are tendencies in our minds to not interpret information the right way. And this is what fundamental research seeks to exploit, these three factors. And the key tenets for how to do fundamental research right is to focus on doing independent analysis. This means looking at the data and coming up with your own conclusions as to what's going on. So not watching CNBC and listening to the experts say that this stock is good, so therefore I'm going to buy this stock. It means looking at the underlying data, drawing your own conclusions and using that to drive your investment. This guarantees you won't fall into the herd mentality that can lead to bad outcomes. Second is having a long-term investing horizon, not caring about short-term moves in stocks, but keeping your eye on the long-term thesis, because markets tend to be emotion-based in the short run and logic-based in the long run. So it's much safer to play in the logic side of the market. And the last is objectivity. Again, trying to remain objective and not let your emotions get in the way. This is the ideal. It's very hard to implement all three of these all the time because our human nature is not to do these things. But that's what we kind of try to do in fundamental research to make alpha in the market. Okay, so what is the formula for alpha? How do we know that we have an opportunity to generate a market beating return in an investment? So this is a really important slide because it breaks it down for you. So the formula for alpha is pretty simple. You have to find situations where you believe the market believes X, but you believe Y. And if you are proven right over time, then you have a situation that will inevitably lead in alpha. So that's why what you're looking for when you're trying to find alpha. Situations where you disagree with the market, situations where you are right to disagree with the market and are proven right. In those kind of scenarios, you will make more money than the market. So unpacking this a bit, we now have a recipe for how to look for alpha. So first we must uncover a hypothesis as to what the market is thinking. We won't be able to see if we're going to generate alpha unless we are able to decode, okay, the market believes X, but what is X? We have to figure out what X is. Second, we have to determine if the facts lead us to agree. If we also believe X after doing our work, then we just simply agree with the market. The market is correct. Only if we disagree do we have an opportunity to generate alpha. So we must look for situations where we disagree. And fourth, we have to be right. And the truth is that it's very hard to be right. Predicting the future, which is essentially what we're trying to do, is all a matter of making educated guesses. And a world-class strike rate in making these predictions is 60%. So just a little bit better than a coin toss. If you're batting 60% in making your predictions, you're going to do really well as an investor. And the best investors in the world typically hit around that 60% strike ratio. So this is a hard thing to do. You shouldn't get down on yourself for making mistakes and being wrong. But you also shouldn't be overconfident in your hypotheses because people make mistakes all the time. Okay. So now I'm going to get into our framework. How do we search for alpha and what's our recipe? So there, you may have heard these terms before, but there are generally two camps in fundamental investing. There's the top-down camp and the bottom-up camp. So the top-down camp, as the name implies, means that the investors start from the top of the funnel. So they look at the macro view of the economy to find sectors that they think will do well. So some examples I've given here. So for example, I think life insurance will do well in India. It is so underpenetrated. This is a judgment about the industry at large that is leading to the investors saying, I find this sector interesting. The second way that investors look to make decisions is bottom up. They look at specific companies, ratios, data, and they say this company looks very good. So for example, this company is really cheap. Its PE ratio is only 10 times, but its ROE is 20%. That's a clear example of bottom-up investing. So typically you'll see investors define themselves into one of these two camps. But really, if you ask me, any successful investors really got to be applying a combination of these two things. So for example, let's consider why we need to do top-down thinking. So the fundamental truth is that every business operates in an ecosystem. No business is operating alone in a vacuum. And even great companies will do badly if the macro setup is not good. So we have lots of examples of this right now. Just look around you. Look at PVR, look at Indigo. These are great companies that were managed very well. But in this kind of macroeconomic environment, the companies are really hurting because no one is able to access their products or are too scared to use their products. So this is a clear example of if you're just focused on the company, you're missing something that's really, really important. The other mistake is also possible where you just focus on the big picture, but that also doesn't work. So why do we need bottom-up analysis? So the way we like to think about it is macro provides the opportunity set for all the players, but it doesn't tell you who's going to win it. So let's take a very simple example. In the 90s, a lot of people spotted that, the technology was going to be a huge thing. And, Microsoft was the dominant player at that point in the early 90s. And people thought they were unassailable, but they missed the macro picture. they didn't realize how much of a game changer the internet was. And as a result, they lost their internet dominance to Google. So this is a clear example of the fact that, both players were in technology, both were chasing the internet. It's just that Google saw it earlier and chased it better. And clearly you had to be doing bottom up analysis to understand who's going to win that race. So bottom up also is the only way to prove alpha. Remember, to do alpha, we have to figure out what the market thinks about a specific company. Is that price justified or not? If we don't do our homework on the company, how will we know if the price is right or not? So bottom up is really, really a crucial part of making individual stock decisions. So how do we do it at Bharosa Club in the small case? So we use our top-down analysis to help us determine where to spend our bottom-up research time on. So what kind of industries do I think will do well given my worldview and top-down analysis, and where should I be looking for alpha on a bottom-up basis? And then the bottom-up research helps me find the actual opportunities and opportunities for generating alpha in the market. And this combination, in our view, creates a lot of efficiencies. So it narrows the number of stocks that we focus on. So we're able to spend our time more smartly and generate better investment theses that benefit not just from the micro details, but also our macro analysis. And we give equal attention to both. Sometimes, depending on the environment, we focus more on top-down. Sometimes, depending on the environment, we focus more on bottom-up. So an example of this is when you see big changes in the macro world. Like, for example, in March, we spent a lot of time trying to understand what was going on. And most of our attention was on the macro side. And we weren't doing a lot of bottom-up work. But that has now shifted to lots of bottom-up work because we are starting to understand the macro picture. Now we need to find the winning stocks. So that's how we balance these two things at our small case. Okay, now let's walk through an actual case study of how this framework works. So let's rewind the clock to late March 2020. There was so much uncertainty at this point. Now looking back, a lot of this uncertainty has resolved, but there's still a relatively high degree of uncertainty around us. So what were the sources of this uncertainty? You probably all know this very well. You lived through it not too long ago. But we had the spread of COVID. How bad would this disease be? We didn't know. The impact of the lockdown. We were doing things that had never been done on an economic stage before in any large way. So what would the impact of this be? We still don't know the answers to how bad this will be or how not so bad it will be. So we're still waiting to understand how that clarifies. How will the governments respond? How will consumer behavior change? And amidst this uncertainty, people like me that were managing portfolios, and that's probably all of you also, how are you going to allocate your portfolio amidst all this uncertainty? So you have to make decisions when you're managing a portfolio, but how to make these decisions when there's so many unknowns? The remedy is to do analysis. Your analysis will never be perfect, but it's more perfect than just dealing with complete uncertainty. So that's really the goal of the analysis. Will it reduce the uncertainty and help you get a little more confidence in terms of what direction the world's going to go? So what we did is we looked at a lot of raw data at that time. So there was data that was available around how coronavirus was spreading in different regions. You probably all have seen this website that shows every country and the coronavirus statistics, hospitalizations, new cases, deaths, etc. We spent a lot of time trying to understand that data, reading the scientific reports on whether the virus, how fatal it was, what the prospects were for a vaccine, what the prospects were for reinfection risk, etc., etc. The news reports that were coming out, the real-time economic data. So there was all kinds of creative data that you could look at to see. So pollution levels, for example, how many people are out on the street driving? If they're not a lot driving, pollution levels fell, and that told us the economic activity was going down. How bright were cities when you looked at them from the satellite images, right? And how much light was being consumed. Less light means less economic activity. So there are all kinds of creative data streams available to help you figure out what was going on. You just needed to dig into them and see. And then Google Trends. What were people searching for? Were they searching for terms like job loss on Google? So for people that don't know, you can access Google Trends data at trends.google.com. This is a tool we use a lot in our analysis to try and get a sense of what are the forces that people are going through at a given time. Then also government announcements, retrospective economic data, backward looking economic data, that is, and your personal experiences. Never leave this out from your analysis. You know a lot about what's going on. First, in your life, are you spending more or less than you were pre-pandemic? What about your friends? How many of them have dealt with job losses or job cuts or income cuts or, so on and so forth? These stories can tell you a lot about the forces that are going on in the economy. So that also is a very rich source of raw data for you to help you manage your portfolio. So we looked at all of this and we focused on drawing conclusions once we had analyzed all this data. And we tried to match it with what we thought the consensus, that means the market view, was. So back then, and remember this, you have to rewind back to March, right? What were the consensus views? So when we looked at the spread of COVID, there was a lot of confidence around the government's early lockdown. People thought that this has given India a huge head start in preventing community spread of the virus. And this worked for a very long time. If you remember back in that period, it took a very long time before we started seeing meaningful cases in India. And India was, heralded as, a country that had maybe avoided the worst. But obviously, very quickly, that has changed now. And even back in March, when we did our analysis, it was clear to us that there was a risk that community spread would happen in a big way in India because we looked at the data. Some people said Indians are immune. So we looked at data from European locations which had seen coronavirus earlier and said, what about the Indians living in these locations? Do they seem protected or not? And we found studies that said no. Indians, Bangladeshis, Pakistanis living abroad were actually more at risk of severe complications due to the coronavirus. So it didn't seem like that was a plausible scenario. Then we looked at, okay, maybe the BCG vaccine, maybe warmer climate. But when we peel the onion behind data on all these things, we said, you know what? There is a big risk that this thing leaks out and actually infects the country at large. So we identified an area where we differed from consensus. Second thing we looked at is the impact of the lockdown and government response. So the consensus view here was that this will have a large economic impact, but the government has room for fiscal support. If you looked at India's debt to GDP level, it was around 60% odd, and that was much lower than many other countries. And so the consensus view was the government is going to be able to support fiscally at a high level, and it's going to be help to plug the holes in the economy. But again, here we disagreed. When we looked at the mathematics, it became very clear to us that given the lockdown, the hole in the economy would probably be too large for any fiscal stimulus to help. We didn't believe that there would be enough fiscal room to plug all those holes. Then when we get to consumer behavior, how will people's behavior change through this period? So the consensus view was you may see a V-shaped recovery and people will basically be so desperate to get back to restaurants, so desperate to go back to shopping malls, so desperate to go travel again, that we'll very quickly see a return in our habits and spending. But when we looked at the data and what people were saying, that a vaccine at that time, they were saying it may take 18 months, looks like we may get one sooner now, but still before it spreads through the world, it'll take some time. We were unclear as to how long this virus would stay. And our worry was that if it stayed long, for a very long period, these habits may crystallize and it may take time before people feel confident enough to do all the things they were doing before. So we identified lots of areas where we disagreed with the market. And most of these were around us being more scared about the implications than the market was. So as a result, what were our conclusions? So when we looked at what this meant, we thought there was back then in March, we thought there was a risk of persistent elevated unemployment levels because of the holes in the economy. We thought there was a risk of inflationary pressures cropping up in certain products. And you're seeing this in some of the data that's come out now, with prices of goods actually becoming more expensive. And we thought there was a risk of excess capacity. What does this mean? Well, think about how many Uber drivers there are across India. Now think about how many trips there are in Ubers now versus before. There are much fewer trips right now. We have too many Uber cars relative to trips that are being taken. That's the fundamental concept of excess capacity. So given this setup, it was very clear that I felt more concerned than the market. Now, we still don't know if a lot of my guesses are right or wrong, right? And this is, you have to get used to this in fundamental research. There's still reasons to believe I've been wrong about a lot of this, right? I mean, maybe the economy will recover faster. That's not the important thing. The important thing is to have a point of view, manage your portfolio around it, and as data changes, you change your portfolio so that you admit mistakes quickly as data comes out and you adjust your portfolio. Right now, I'm still sticking with my view personally. You may disagree, we're entitled to disagree. But given that viewpoint, we oriented our portfolio around industries that we felt would be safe. So FMCG, pharma, and agri were the main areas where we searched for bottom-up winners. So let's actually take a look at how we transitioned from this top-down view to now finding winners. So great, I had a view of the world. Now, how do I find the stocks I want to buy? So the first thing was we looked for stocks where the price action suggested to us the market was maybe overreacting in situations. We would not know until we finished our work whether the market overreacted or not, but there were interesting situations. So one stock that jumped out to us was UPL. Now, at that point, I didn't know too much about UPL. I knew that it was in the agri market. I knew they made pesticides. And that's about it. I knew they were a fairly large company. I hadn't done my work on it yet. But the stock price chart to me looked very interesting. It was clear the market was very fearful about this company. It was trading at around 500 to 600 rupees before the pandemic. Pandemic hit and it cratered all the way down below 300. And this looked very interesting to us because the PE ratio at that point was around 10 times, which was about half of the average PE in the market. So this was a company that was clearly trading at a low valuation. Now the question is, was that valuation warranted or not? So how did I answer that question? Well, we did our bottoms up work. So that meant we looked through all the filings that the company had, the annual interim reports, the earnings call, the press releases, the news, website, personal experiences, relying on your experiences, and Google Trend data also are all great sources for you to look at when determining what the prospects look like for a company and they won't all apply to a given situation. Like for example, Google Trends is not very relevant for UPL, but for other investments it is. So let's understand UPL a little bit at a high level. So UPL sells crop protection products. This basically allows farmers to ensure that their yields are somewhat protected, because if a farmer, for example, gets some sort of disease in his crop, then his entire crop may be wiped out. So UPL helps him lower the risk of that happening. You can almost think of it as an insurance of some sort that the farmer is using. And it has about 35,000 crores in revenue, annual revenues. So it's a very large company. And around 80% of its revenues are in developed markets and LATAM. And it plays big exporter. And it plays a very valuable role in keeping food costs lower by protecting the supply of crops. The company had just made a pretty large acquisition, a $4 billion acquisition of a company called Arista Life Sciences, and it had borrowed this money. So it had funded it through borrowing from banks and bondholders. And the latest results looked pretty decent. It had posted 13% like for like revenue growth in the last year, 13% EPS growth. So it didn't seem like the company was not performing on an income statement basis. So why was the company trading at 12 times? Didn't make sense. Something was missing. What was the market seeing? What were they scared about? So digging deeper, it became very clear what the market's concern was. So now we had a feeling that we knew what the market was thinking. Now we can apply our formula for alpha. Do we agree or disagree with the market? If we disagree, maybe we have a situation where we can generate alpha. And that's exactly what happened. We disagreed with the market, and therefore we took a position in UPL. It became one of our conviction picks and ended up being a winner for us. And so let's understand what the market was concerned about and why we thought it wasn't a concern. So when you looked at UPL's balance sheet, it was clear that the debt, the borrowings the company had taken out to fund the acquisition were pretty high. They were leveraged, which 3 times on a net debt to EBITDA basis. For people that aren't familiar with what that ratio is, don't worry. It just means that they had a fair amount of borrowings relative to the amount of cash flow the company made every year. So the market was clearly feeling maybe there's a chance this company goes bankrupt if things get really bad. But when I did my bottoms up work around this, I felt like that risk was overblown. Why? First and most importantly, the company was linked to the agri end market. People were still eating and they had to eat. They were going to buy food. So food is one of the most resilient categories in the economy because it's a necessary thing for people to do. They have to feed themselves. So spending would happen in that category. Maybe they trade down, spend less, whatever, but you knew they were going to eat. So it's relatively a stable category. Second thing is, when I looked at the data around the debt, it became clear to me that UPL had a lot of flexibility in its debt. First, its debt was not due for many years. So that meant they had room. They didn't have to pay back that debt tomorrow or in a year. In fact, most of UPL's debt was only due after 4 years. So they had a lot of time to see improvement in their business in case things went bad. And lastly, their interest costs on that debt were very low. They paid a very low interest rate because most of their debt was denominated in USD and Euro. So the interest rates they were paying are low. And obviously you take the foreign exchange risk, but I factored that into my analysis also, and I was willing to take that risk. So that's one area where I disagreed with the market. I didn't feel like the risk of this company going bankrupt was as high as the market was pricing in at that time. The second thing is I looked at some news that had emerged around draft regulations banning certain classes of pesticides. When this draft regulation was announced, all the crop protection stocks got hit because the market was afraid that these pesticides would be banned and the companies would not be able to sell them. But when I dug deeper, it was clear that UPL actually was one of the companies that would be affected least by these regulations if they passed, because it was an export business. So the chances were that if these pesticides were banned, they would only be banned in the Indian market, not abroad. So that would insulate the impact from UPL since its India sales would go, but not its global sales. And there are also substitute products that UPL had in its portfolio that could lessen the impact of this. So I didn't think this was such a big deal. And lastly, I didn't think the government would go ahead with the ban because it would raise the cost to farmers at a time when they needed to do all they could to keep food prices low and to keep the economy vibrant and healthy. So I took a view on this. Obviously, I could have been wrong, but I factored that into my calculations and judgment about the stock. So here was another area where I disagreed with what the market was thinking. And so, you know what? I had a situation where my analysis told me that you believe Y, the market believes X. Maybe this is an opportunity where you want to bet against the market. So the conclusion of the bottoms up work was we identified the market view, we disagreed, we did detailed work behind our thesis that we disagreed with the market. So that gave us confidence. And the valuation of UPL was so low where the upside was very big if we were right. We thought the stock could double if we were right. And we thought if we were wrong, then we would recognize, manage it, and exit the stock. And we were taking some risk that we were wrong, but we felt like the upside potential was much higher than the downside potential. To manage the risk that we could be wrong, we sized the investment in our portfolio relative to the risk we perceived. So initially we took only a 4-5% position in UPL. And as we started getting more and more confidence that the bankruptcy risk around the company was not high, we doubled the position size as we got more confidence. So we actually increased it to around 7-8% once we got more confidence in the conviction in the investment. And this is what you can do in your portfolios also. When you get confident, increase the size of your bet. So in this case, the investment worked out, and at least for now, right? I mean, we don't know what direction it's going in the future, but it has worked out reasonably well for us. Our average cost basis was around 400 rupees a share, and now UPL is trading at north of 500 rupees. So it's been a good investment for us. Always build in margin for error in case things don't go the way you expected. I can tell you that I did not expect in March that the markets would be, trading at the levels they're trading at now. I thought they would be lower than where they are. So clearly the market has not agreed with my top-down view yet, right? And even though that did not pan out, the investment panned out because I created margin for error. If the economy did well, UPL would do well. If the economy did badly, UPL would do better than most other companies. And so it was a win-win scenario for us. And that's why we took it as a big bet for us, relatively 10% odd, 10% bet for us. So that's kind of how we achieved our investment thesis. Okay, great. We covered a lot. Now, what would I take away from this if I was not in the business of managing an active stock picking talk? How can I use this for my portfolio if I'm not going to do bottom up work? So here's kind of what I recommend for the takeaways for everyone on this call. So I agree, bottom-up work is very difficult to do well. You need to speak the language of companies. You need to be able to read a balance sheet, understand it, read an income statement, understand it, and it's going to require work, time to do right. And if you're interested in that, you certainly can do it. Okay, there's nothing stopping you from doing it. And in fact, we have some series on our YouTube channel that help people that want to do bottom-up work understand how to do it. So there's a great series we have called Stocks Zero to Hero. If you're interested, check it out and see if this is something you want to do. But for most of us that don't have the time or desire to do bottom-up work, what we really recommend is you can still do top-down work pretty easily. And this will be really beneficial for you if you do it. So our recommendation to all of you listening, start getting in the habit of trying to think independently of the economy at large. So how do you do this? You stay on top of the news, economic data that's coming out. You talk to people that own small businesses. You talk to your friends. You figure out what's going on. Just devote some of your thinking to having a view on what's going on in the market, in the economy rather. Now, why do we say this? Like we said, you probably will be wrong. Quite often you'll be wrong. Even if you're wrong, if you have a view and you manage your investments to that view, you'll know you were wrong and you'll know to adjust your portfolio quickly. If you have no view at all, you're not going to be able to adjust your portfolio. So I'll give you an example. The Bharosa Club Top 150 small case had a very large financial sector exposure prior to February. It was one of our largest exposures. We had stakes in a lot of the top performing financial services companies. But we had a view that the economy was doing reasonably well and these companies were safe. But it became very clear when COVID came on the scene that that view was no longer correct. There was a big risk to the downside. So we were able to adjust our portfolio quickly, get out of those stocks and adjust our portfolio to be more defensive. And that's what having a view can do for you. Even if your view is wrong, you'll know it and you'll be able to tweak it. And it'll help you pick the right active managers that agree with your view of what's going on. So it's really, really would be my key takeaway from this. If I were listening to this web seminar, that is the one thing I'd really take home. Spend some time, think about what's going on, look at the data, try and come up with your views. Do you think consumers are going to bounce back? They're so tired of being in their homes and they're going to, spend and get this economy going quickly. That is a view. And you are just as fit to have that view as anybody, So really, really encourage people to do that. Most of the active fund managers' edge comes in bottom-up work because that requires a lot of training to do well. But top-down work is notoriously difficult because anyone can do it. And because anyone can do it, you can do it and be better at it than your active fund manager. So really, really encourage you to do it. So with that, I'm going to open it up for Q&A. Before we go to Q&A, just a few links for people in case they want to learn more about us. So first is our small case. Second is our YouTube channel. You can find us at Bharosa Club on the YouTube channel. Subscribe to our videos and you'll get updated whenever we have a new video. And then our club membership, you can go to our website and learn more about that club membership. And so with that, I'm going to stop the screen share and I'm going to open up the questions and then we can look at some of the questions. Okay, great. Okay, so let's see. I'm going to pick questions that I feel a lot of people will help a lot of people. So let's go with the first one. Okay, so Atul Kumar asked a question. How can we believe on stock selection and adjustment by small case? In case of huge loss, is there any responsibility? So this is a good question. Whenever you're investing in anything, you should take the responsibility of the success of that or failure of that investment on your shoulders. Because at the end of the day, if the investment does badly, ultimately, very few investments you're going to have some recourse on. And so you should treat every investment like it's my responsibility to do my own due diligence on the small case to make sure that I believe the active manager is a good active manager. I believe in the strategy, understand the strategy, read the docs, ask questions if you're confused, and take that responsibility on yourself. The worst thing you can do when managing your personal finances is say, you know what, if I'm just going to go with this active manager, hopefully he does well. No, you should take the responsibility on yourself. So that's kind of my view on that. And again, having a top-down view will help you do that, right? So for example, let's say that I did a top-down view and I thought, I think this economy will probably rebound a lot better than people think, right? Then I came across the Bharosa Club Top 150s blog and I saw that Bharosa Club was saying, you know what, we don't think the economy will rebound that quickly. Then I would not invest in that small case, right? I would say this manager doesn't agree with my top-down view. That's a way you can take more responsibility on your shoulders. Okay. So another way to get confidence is to do due diligence on the advisors. Who are these people? What is their track record? And how much risk are they taking? How much volatility is in the portfolio? These are all questions you can do to make better decisions about picking the right small case investor. Okay. Okay, so Varun Dayal asked, is there any ideal portfolio size in terms of value or percentage of wealth? Or can I SIP into this for the long term so that the PF value plays the value of an otherwise MF long-term SIP? So Varun, great question. Our recommendation is that when you invest in the equity markets, you should do that with money that you can keep in the markets for 10 years. That sounds like a very long time for most people. But the reality is stocks are very long duration assets. If you're putting short-term money in markets, you don't know what the market's going to do in the next year. You could have another crash. You could, so putting short-term money in the market, you're taking the risk of volatility. So the question I would ask myself if I was a young person trying to figure out how much to invest, I would make sure I had enough money outside the stock market to cover any emergencies. That way, I would know that whatever money was in the stock market could sit there for 10 years, wait for the power of the stock market to do its thing, and I could see that investment grow and not have to break that money, that investment, when the market prices were low. So that's my recommendation, how to determine the percentage. Okay, so Sonal Ahuja asked a very good question that I think a lot of you are probably thinking. What explains the reversal of the stock market despite macro level fundamentals declining? So Sonal, this is a great question. No one really knows the answer to this conclusively, but we can guess. And our guess at Bharosa Club is that there are a couple of fundamental things going on. One is the liquidity in the market has increased. So if you look at what's been happening worldwide, there's a lot of new money that's been created as central banks try to fight the virus and the impact of the virus. That means there's a lot more money chasing investments globally. And now, given where interest rates are, you may have noticed your savings account is paying you much less than it was, 12 months ago. So when you look at the alternatives you have, you can say, do I put this in a savings account where I'm hardly earning anything? Do I put this in a bond where I'm hardly earning anything? Or do I put this in the stock market where I'm earning a little more? A lot of people are opting to put it in the stock market, right? Now, they're taking a risk, right? Because will the market go up or down is anyone's guess, but more people have decided to put their money in stocks, and so the stock market has increased in value. No question, macro level fundamentals have declined, but a lot of people are saying, you know what, from this level, there's going to be a lot of good news coming out as we gradually reopen, right? So things have bottomed now and people are looking forward and they're saying, okay, off this low base, things will probably do better than people expect. So if you view that, then stocks may not be a bad place to be. Now, I tend to agree with you. We are scared that the knock-on impacts of this are not understood properly, because there is a very large income hole in the economy, in our opinion, which can reverberate through the economy. And that's our big concern and why we're not very aggressive at the moment. But you need to do your own thinking around this topic too. Manash Kumar asked a good question. You mentioned FMCG, agri, and pharma. What is the perspective on IT? Don't you think IT is safe too? Yes, Manash, we do think IT is one of the safer sectors to be in. So we do have IT positions in our small case as well. My mistake for not putting it on the slide. We like IT because obviously one of the big challenges of this period is it's harder for companies to reach their customer. If I'm operating a bowling alley, right, it's almost impossible for me to reach my customer because my customer is too scared to leave the house. He's scared if he goes to a bowling alley, he might get COVID. So I can't sell my product, my service. If I'm running an IT company, I still can because it's digitally done. So IT can be a very safe place to be also. But just because the industry is safe, you also got to look at the valuations of the companies in the industry. So, InfoEdge as a stock, for example, has done very, very well, but the valuation of InfoEdge is really high. So the question you got to ask when looking at IT companies is the company going to do well, one? And is the price of the stock reasonable? Because even if the company does well, if the expectations are so high, even if it does well, but not well enough, the stock could go down quite a bit. So you got to balance these two things. Okay, let's see. Okay, Sonal asked another good question. So how do you pick stocks within a specified sector? You mentioned FMCG, but how do you choose a stock within the sector? Great question. So one of the other winners we had was Britannia. And this is a good example. We knew we liked FMCG. And when we looked at the stocks within FMCG, we were looking for companies that seemed too cheap relative to other FMCG companies. So we saw Britannia. And one thing we really liked about Britannia is it was trading at, say, a 50 times PE, trailing PE, versus a 60, 70, 80 times PE for some of the larger MNC FMCG companies like Nestle or HUL or Colgate, Palmolive, etc., etc. Now, when we looked at that, we actually liked Britannia's portfolio much more, given the macro environment, than we liked HUL's portfolio, as an example, because Britannia was exclusively selling shelf-stable packaged foods. This is exactly the kind of products that people were buying more of. They were buying more biscuits, they were buying more bread, they were buying more things that would help them eat at home. And so we found a stock which was cheap relative to its peers, but we felt would actually benefit much more from the environment that was in front of them. So that's kind of a flavor of how we picked our FMCG player. Okay, let's see. What other questions do we have? Okay, Siddharth, can you give an example of one post-COVID bottoms-up approach that failed? Sure. So I'll give you the example of InfoEdge. That's a very, very good example. And that failed because we decided to sell the stock. But the company has now gone up probably 50% from where we sold. So we missed out on an opportunity to make money. That's as much a failure as picking a bad company. So why did we make that? Why did we miss out on that return? When we looked at InfoEdge's company on a bottoms-up basis, we felt very nervous about its core businesses. So a big portion of InfoEdge's business comes from Naukri, and they also have a real estate platform called 99 Acres. Both these businesses were exposed to areas we thought would not be doing well. We didn't feel that people would be looking to add new employees. So we didn't feel good about the Naukri business. We thought maybe people will actually reduce their activity on Naukri. Some people may not subscribe to the Naukri service for some period of time. We thought we'd see a lot of deterioration in the Naukri business revenues. And on 99 Acres, similarly, we thought that who's going to be buying new real estate right now? People are feeling very nervous, and real estate prices anyway were thought to be pretty high by most people. So we also thought that business wouldn't do well. And we looked at some of their JV investments. We thought Zomato would do well, but we thought the valuations were already reasonably high. What we missed, and what explains the rise in the share price, is that we were right. A lot of these core businesses didn't do well. Their revenues were down as much as we thought they would be down. But we missed the fact that the company could raise a lot of money and deploy this money in other businesses that needed capital, and that may create value creation over time. Look, my personal view is, InfoEdge, did we miss something? Absolutely. Is the stock, at a level that makes 100% sense? Not so sure. I think it might be a little expensive, even given that amount of capital they raised. So that's an example of a mistake where we didn't interpret. We missed out on one of the advantages. Another one would be Reliance. We were late in getting into Reliance. We saw the amount of money that they were raising. We should have realized that this created an opportunity for the company, but we were very, very late in adding Reliance into our small case. So mistakes will happen, and it's great that you're asking this question, because I don't want to make it seem like we have a crystal ball and that everything we say happens. You have to get used to making mistakes to become a good investor, because you're going to fail, 40% of the time, even if you're a rock star. But the good news is, if you're doing that, you're still going to make a lot of money over the long run. Okay. Could you speak to the downside protection in your small case? Good question. So I would say it's hard to make a concrete case for how much downside protection there is. But what I'll say is that the downside protection in our small case comes from a couple of things. One, we're focused on large cap stocks. Large cap stocks, as I mentioned earlier, they have less volatility. So when you think about the downside risk, we're already playing in a safer sandbox. Second, we are picking defensive sectors where we believe the businesses will perform no matter what the economic conditions look like. We may be wrong, but we're trying to pick businesses where we think they're not too sensitive to a prolonged recession. So for example, in the FMCG world, we don't have ITC in our portfolio because we're worried about some of the sectors that ITC has got in its business, like the hotels, etc. So that's the second area of downside protection. We're not aggressively betting on a bounce back. So that may mean if there is a bounce back, we may very well underperform the market. But if there's a protracted downturn, chances are we will do better than the market. Also, we have a sizable allocation of gold in our small case. Around 10% of the portfolio is in gold and 5% is sitting in liquid. And we have a 5% allocation to the NASDAQ ETF. So we have a fair bit of what I'll call dry powder, which is capital that we're leaving in safer asset classes that are non-correlated because we are opting for a more defensive approach right now. And when we become more aggressive, we'll probably change the allocations of those assets at the right time. But those are the principal areas of kind of downside protection that I would speak to in our small case. Okay, great question from Viral Parekh. Where do I get information for macroeconomic situation? News channels are more noise than real information. Viral, I agree 100% with you. So, it's hard to find quality information these days. What I would say is try and find a handful of people who you think talk sense and then try to follow everything that they say. That's one really good source. So there are a handful of investors that I follow very closely because I really respect their independent thinking and analysis. So I'll give a few of names in case anyone wants to follow them. One is Ray Dalio. He manages Bridgewater Capital, a US hedge fund, one of the largest hedge funds in the world. I think he's a superb thinker. And he speaks quite often, and you can find his clips on YouTube, etc. So that's a great source of information. Second is Howard Marks. He manages a fund called Oak Tree Capital. He publishes memos every once in a while. And so you can read his thoughts on the economy. And these are great ways for you to get quality thoughts on the economy. Then obviously Warren Buffett, whenever he speaks, I listen. So that's one great way to do it. Second is, you're right, I would ignore a lot of the noise that you get, but focus on the data. Don't focus on the headlines. For example, you may read a headline that says, sales of electronics are up 45% this month. That is noise, right? Because it's coming off a very low base, but you can calculate the true headline for yourself. Look at the metrics in the piece and try and draw out the true headline of what it should be. How does it compare to a year ago, right? So try to focus more on the data and less on the headline. Then also, I would say that basically, we also, for members, we have something called Brain Food. Every week for our members, we post something, either a podcast or an article or data or a memo from someone that we think has really, really good information in it. So, you can also join our club and get that Brain Food every week. That's a great way of kind of getting quality information. Look for something that curates this information for you. Because you're right, in a world of so much information, you need to be able to sort of figure out the good stuff from the bad stuff. Okay, great question from Manash Kumar. Is it a little too late to take fresh position in UPL or pharma, PF, GC and IT sectors? Good question. So look, Manash, I think you're onto something here. Stock valuations in general are very high. I don't think personally this is a time where I would expect very, very strong short-run returns. I may be wrong. You may see the markets go up big time if we get a vaccine approved and it's safe and a lot of people are taking it. Maybe you'll see the markets rip higher. But there's also the risk that we get bad news, right? Donald Trump's in the news right now. What happens if he passes away? What happens if the Democrats win? What's the stock market going to do, et cetera, et cetera, et cetera. So I think betting on where the stock market's going to be in the next 6 months, very, very hard to do and consistently and do well. There's too much variability to that. Instead, focus on this being long-term money. So is it a little too late to take fresh positions in UPL or pharma? For long-term money, I'd say no. If you find companies that you think are going to be winners for years and years and years, even if the valuations are a little stretched, it'll matter much, much less after years and years of compounding growth. So if you find winners and the valuations are not too crazy, you can still possibly find some opportunities. But I agree, I wouldn't be too heavy-handed in the equity markets right now. Caution is probably better. Gaurav Malhotra asked, what is your view on hospital sector post-pandemic? Gaurav, this is a great question. And this is an example where top-down thinking shows its danger. Okay, so I think this is a very complicated question. And to be honest, I've not studied the hospital sector, so I won't be able to answer the question very well, but I'll tell you some of the factors you should look for. So one line of thinking could be, look, we have a pandemic. People are going to get sick. They're going to end up going to hospitals and they're going to end up paying for those services. So obviously hospitals will do well, right? And that's a top-down view. But to really answer this question correctly, you're going to have to understand the dynamics. How much is the government allowing people to charge COVID patients? Does that cover the cost of service of patients? Is there a problem of bad debt at the hospitals? Are the hospitals getting overloaded? Are they able to source enough doctors to meet demand? Right? All of these issues impact how a hospital performs. So I haven't studied the issue. So I can't have a very informed view on this, but these are some of the topics I would research if I were you and you're looking to take a position in the hospital sector. You may come to a favorable conclusion. You may say that, you know what, this hospital is going to do really well, but you've got to study these issues to make sure. Okay, Miten Shah, but UPL promoters have reduced in the June quarter vis-a-vis the March quarter. If the promoters are not confident, how can we be? So Miten, this is a good point. Insider sales do matter and they are a data point that you should look at, but they're not the be all and end all of decision making. Because if it were, our job would be very easy. We just track insider buys and sells and follow our portfolio on that basis. But there are lots of reasons insiders could sell. Maybe they need the capital for something else. Maybe an investment of theirs in something else hasn't done well and they need money for cash flow liquidity reasons. For example, Aditya Puri sold HDFC Bank's shares, sold all his position. One reason could be he doesn't feel optimistic about the share price of HDFC Bank. Another could be, no, he is now going to retire and he just wants to have a clean break. So it's a data point to think about, but I wouldn't base your entire decision-making on that. Trust your analysis over insider sales. Okay, Ricky, what is a better measure of portfolio growth? CAGR, beat the market, beat the inflation, beat FT? So Ricky, I think the best answer to your question is to compare the portfolio growth to the volatility of the portfolio. So one of the things that I'm proud of our 1 year performance, we've completed a little bit over a year since launch, is not just the CAGR. Okay, it's also the volatility post-launch that we've demonstrated. I think if you look at the statistics, not only is the return decent, it's come off of a much lower volatility basis. We're taking less risk than the market. And really, that's what you want to compare. You want to compare the risk of an investment versus the return. And the best way to do that is to look at the Sharpe ratio of the portfolio. And what I'd encourage you to do is calculate the Sharpe ratio post-launch of something. Backtests are great. They can give you a flavor of how something's performed retrospectively, but I wouldn't trust those numbers like a post-launch number. It's very important as you select active managers to look at actual data. How have they done in actuality, not on a backtest basis? So to give you an example, if I had a very, very safe investment, as safe as a FD, even if it was generating 50 basis points more than an FD, that is a terrific investment, even though the actual percentage may be low, because I'm taking absolutely no risk on it. Whereas even if I have a 50% CAGR, if I'm taking loads and loads of risk and the portfolio is volatile as anything, then it still may not be a good investment. Maybe I've just gotten lucky, right? So you want to also factor in volatility. COC acceptor, does Bharosa Club use factor investing? If so, what factors do you recommend? We don't use factors to make the final decision on investments. We do use factors to help us screen potentially interesting stocks. So I'll give you an example. We look at relative performance and momentum cues. We have an algorithm that helps suggest stocks to us. And we sometimes get good stocks from that algorithm, which meet our fundamental research criteria. So one example was Muthoot Finance. We saw the relative performance of Muthoot and we said, you know what, this company is doing well. It makes sense. It's doing well. Maybe we should take a position in it. I think factor-based investing, I'm not a fan of factor-based investing to make the end decision, because the truth of the matter is factors change. I'm not a believer that you can have a simple formula that beats the market consistently, because markets are unpredictable and they change on a dime. And the danger with relying on factors and formulas to make your decisions for you is you're not going to know when those markets and conditions change. So they're very prominent examples. There's a company called Long-Term Capital Management, which relied on on quantitative, correlations and arbitrage, and using factors and statistical data to find arbitrage opportunities. This hedge fund did so well. They were doing 30%, 40% returns year after year after year. And suddenly they went bust because the world changed on them. Their factor models did not change in time, and they lost all their money overnight. So personally, not a huge fan of this kind of stuff, even though there are examples of people that have done factor-based investing very successfully for very many years. I still like the knowledge that you understand what's going on beyond the factors. What is the total number of stocks in Bharosa Club? If it's more than 20, then certainly it will be difficult to manage and look on each micro factor. Good question, Vivek. We look to have a 20 position portfolio. Currently, we have 17 stock positions and 3 broad positions. So gold, liquid, and NASDAQ ETF are 3 of our broad positions. The rest are individual stocks. And I'd say that the level of work we do on a particular stock varies with how big of a position it is. So for example, we have 3 conviction positions, which are double the size of the other positions in our portfolio. So we tweak how much work we do depending on how large a position we want to take. So that's how we manage the work, but still get the diversification. Okay, so, Raju Odedare said, what if I'm finding everything is good in X company and still the rating of that particular company is very low at the time? Shall we go with the company or not? Example, ITC. Really good question, Raju. I think it's very nerve-wracking as an investor when you're going against the market. So when a company has a rating, I assume you're talking about an equity research rating or a Moody's rating or something. Someone has expressed a point of view on the company. Now that person can be right, can be wrong. and you are doing your own analysis and coming to a different conclusion. The answer to your question really comes down to how much work have you put into analyzing ITC? How confident are you that the market is wrong? And the more analysis you do, the more confidence you will have to go against the market. It is hard betting against the market. It's very hard. For example, uh, 2 months ago, our small case underperformed the market by quite a bit, by 3-4 percentage points. And, I was not happy about that, obviously, because, you want to beat the market. But, I had enough confidence in my analysis that I didn't want to change the portfolio. Because I had done my thinking, I had done my research, and you know what? I wasn't convinced that the market was right. You want to do the same thing with yourself. If you're going to bet against the market, you really want to have done your homework. And if you're not able to do that degree of homework, you don't have the time or you don't know how, my recommendation is do not get into individual stocks. You don't want to risk it. Individual stocks are very risky. It's better to find an active manager you trust to do that bottoms up work for you, or to invest in a passive fund. What most investors don't realize is that the vast majority of active fund managers, they underperform the indices in the long run. But the very few top ones, they will give you the alpha. And if you're going to do some homework on your own to find these in really good managers, then you are going to generate alpha. But otherwise, it's totally acceptable to do a more passive strategy. Find a fund house that's very diversified, that's not taking a sector view, that's just looking to beat the indexes by a little bit. That's low risk and not even moderate risk. Like small case has a very good portfolio, the all weather small case. We really like that portfolio. That's a great vehicle for a lot of investors that aren't willing to do the homework that they need to do to have a point of view on the market. But I wouldn't recommend taking individual stock positions unless you've done a lot of homework, because it's hard to bet against the market. And if you're not betting against the market, there's no point, because you're just sort of going to generate the efficient return on that. Okay, I think, let's conclude for now. We had a great session. Thanks for the wonderful questions. A lot of good questions. If anyone wants, any questions answered that we didn't get to, you can email us at advisory@bharosaclub.com. We'll try and get back to you as soon as possible. Thanks so much, everybody. All the best.